Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, February 12th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is risk assets remain bulletproof in the face of rising tail risk. The nuance there is that Fed fund futures are now pricing in only 4.5 rate cuts for 2024, down from 6 at the start of the year. Risk assets digested the hawkish repricing well, with U.S. CPI on Tuesday, U.S. PPI on Friday, and a boatload of Fed, ECB, and Bank of England speak throughout the week. We will learn quickly whether that sanguine response was justified. Elsewhere, U.S. presidential frontrunner Donald Trump remarked that Russia should feel free to invade the countries of NATO members that failed to meet their defense spending obligations. In terms of market implications, asset markets have shrugged off mounting geopolitical concerns thus far, but we reckon they would not if Russia attacked a NATO member country. Given that our positioning model continues to flag elevated risk of a cross-asset correction over the short to medium term, the risk of geopolitics creating problems in asset markets is much higher today than it normally is. Transition to our 42 macro dashboard here. So get some important signals from our in terms of the trading ranges from our friends over at Longbow. We got an oversold signal here in ag. It's DBA, the ETF there, getting an oversold signal in base metals as well. In terms of, I think we had a couple of overbought signal here, a near overbought signal in the NASDAQ. It's been, pretty much that for a few days now. Certainly an overbought signal here in the Russell, an official overbought signal there in the Russell. And I want to say there was one more signal. Yep, Bitcoin there, still well north of its upper boundary of its range, though. So good spot to be taking a little bit of risk off the table from the perspective of the crypto and equity markets, and maybe allocating a little bit more risk to the commodity markets, just based on the amalgamation, sort of the composition of those signals. And then, as always, we'll wrap up with a question from a subscriber in our community here. So the question reads, what would happen if inflation went back up? Would the Fed start raising interest rates again? And how would this affect, how will the stocks, the dollar, and bonds react to this scenario? So those are all pretty easy questions, and questions we obviously have addressed in various facets in our research, most deeply in the left tail risk section of our most recent macro scouting report, our February macro scouting report. So obviously we don't need to rehash all the information and content there, but just summarizing the key takeaways. Inflation started to trend higher again, an emphasis on trend. I don't think 1 month of inflation data, not even really 2 months of quote unquote bad inflation data, would necessarily create a big significant change on asset markets in terms of repricing the fixed income markets. But if we were to start to see, let's say, 3 or 4 months of inflation really just obviously moving in the wrong directions from the perspective of the leading indicators, like the 3-month annualized rates of change, 6 months annualized rates of change, if we started to see some real negativity there, we don't expect the Fed to start raising interest rates again, because again, they paused, they stopped hiking when inflation was much higher. So obviously the implication would have to be we need to see inflation much higher to get them going again on the policy rate tightening front. But it's very likely that we would see effective rate hikes in money markets, which obviously spill over into international bond markets as well. So, whether the Fed hikes rates or does not hike rates, I don't think that would matter. What would matter is what happens in money markets, what happens in asset markets, and ultimately that would be quite hawkish if we did start to see a trend higher in inflation. By the way, we are expecting a trend higher in inflation to begin sometime in the second half of this year, likely by the end of Q3. At least that's the kind of modal outcome from some of our more kind of metric systems that we use to project growth in inflation. And just in terms of piecing it all together from a from a qualitative standpoint, we are expecting inflation to kind of bottom at some point. That's at a level that's unpalatable for the Fed's 2% inflation target. But again, that's something that we expect to see 1, 2, perhaps 3 quarters from now, not necessarily in the very short to medium term. And obviously the key takeaway for all this is that if we do start to see adverse outcomes on a trending basis with respect to inflation, then that's obviously bullish for the dollar, bearish for stocks and bonds, and very similar to a lot of what we saw last summer into the early fall. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, February 12th, 2024. I hope everyone has a wonderful day out there, and congrats to Chiefs Nation. Hell of a game. Got very wildly entertained yesterday globally. So I'm grateful for the NFL and all the wonderful things that they've done for us in our wonderful global community here. So I just want to say congrats to Chiefs fans all over the world, and congrats to fans of greatness all over the world. We'll catch you back here tomorrow. Cheers.